Again, I know you're probably used to seeing my face as I've been here for the last few weeks. And today we're going to wrap up our series by talking about the balance sheet and income statement in detail, as well as some trend analysis and dashboards. So a quick reintroduction. My name is Juliana D'Angelo, and I've been in the consulting department at Clark Nuber for almost 4 years, and actually started my career in Clark Nuber in 2006 in the audit department, and then worked at various private companies and had my own consulting business for a few years before coming back to Clark Nuber, where I provide CFO and controller consulting as well as manage accounting services for a few clients. And Josh, if you could introduce yourself.
Sure. Hi, everyone. Welcome back, those familiar faces from when I presented a couple weeks ago. And to the new faces, I'm Josh. Been with Clark Nuber for a little over a year now, been in public accounting for 10 years, been doing most recently CFO and controller consulting for a lot of different industries, but one of them being the construction industry. So I am pretty well versed in the industry that you guys are all involved in. I've also dabbled in fraud and forensics and audit as well. So it's good to be here and happy to be sharing some knowledge with you guys today.
Awesome, thank you. So our agenda today is we're going to focus on the balance sheet and income statement. We're going to do a brief overview of cash flows and the statement of equity. And then we'll look at some trend analysis and creating some KPI by using ratios in Excel. And then Josh is going to show us some great software add-ons that you can get to connect with QuickBooks that create some really sweet dashboards for you. So yeah, let's get started. Financial statements. Our first polling question is, do you utilize the custom reporting in QuickBooks Online or QuickBooks Desktop?
All right, awesome. You guys are very fiery today. We already
Pretty
got all
split. Nice.
Yeah, and it is a fair split there. So I'm going to share those results.
Awesome. Okay. Look at that. I'm glad to see that there are a lot of you utilizing those custom reports, so you know how to dig in and make those changes that you need to make to get the information that you need. So that is great. So financial statements. The companies in general prepare 4 basic financial statements. The balance sheet reports the resources owned by a company and then the claims against their resources, whether they be liabilities or equity, at a specific point in time. So when you run a balance sheet, you run it as of September 30th. It's not over a range, it's just giving you that specific date and time. The income statement reports how well a company is doing and has performed its operations over a period of time. So you always need a starting date and you always need an ending date. So that's why when you see an income statement, it'll say for the month ended, or for the 12 months ended, or the 18 months ended, depending on what period that you're looking at. The retained earnings statement reports how much of a company's income was retained into the business and how much was distributed to owners over a period of time. So after you've got your profit and loss activity and you have your net income at the base of your profit and loss statement, that net income is what you are essentially retaining into your company, and it gets closed out onto the statement of retained earnings, which kind of flows into your balance sheet. So it's important to know that relationship, because QuickBooks sometimes shows that retained earnings number a little different on occasion. You need to understand if it actually includes your current period's closeout of income in it. So it's an important thing to think about. And then the statement of cash flows reports the sources and uses of a company's cash over a period of time. So this is really, really helpful when you have an accrual-based financial statements and your cash is low, but your revenue is high, and you're trying to understand how all of that is related. So it's important to understand how to create a statement of cash flows just so you can really get an idea of what the sources and uses of your cash is. This is not a frequent statement that is created for small businesses, but it's important for you to understand its components just so you can identify how things are affecting cash. So timing of financial statements, we kind of just talked about this, but at the balance sheet, as I said, is at a point in time. And then we have our period of time financial statements, and that's going to be your income statement, your retained earnings statement, and your statement of cash flows. While financial statements can be prepared for any point or period of time, monthly, quarterly, or annually, most companies prepare financial statements at the end of each month, quarter, and year. Note that the balance sheet is a point in time description, whereas the other financial statements are period of time descriptions that explain the business activities between balance sheet dates as shown in the slide. In order
Julian,
to
if I can cut in real quick to give some tips on QBO usage of when you're going to those customer reports, or if you're just going into your balance sheet. The reason why QuickBooks will ask you for 2 dates for your balance sheet report, even though it's only reporting at a point in time, is if you click on one of your accounts and want to drill down to the information inside of that account. If you're only using 1 date, it's only going to show you the activity for that account for that date. But if you use a date range, when you drill down to that account, it'll show you all of the information for that entire date range. But that's why, even though you can change the date range, the results that it's showing you on the actual balance sheet won't change, because it's showing you at that point in time what your balance was.
Awesome, thank you. So comparability of financial statements. I know that we've talked a lot about accrual versus cash, and we've gone into generally accepted accounting principles, which is not a big issue for you and your businesses, but it is important to understand that in order to make it easier to use these financial statements over time and across companies, a common set of rules and conventions have been developed to guide that preparation, and though that is the accrual basis accounting as presented in the generally accepted accounting principles. As far as your business is concerned, it's important that your financial statements are consistently presented in either accrual or cash basis. So at some point in time, if you do move your reporting from cash to accrual, then you actually have to make an election for your tax return. And then you also need to understand that that should carry out in how you're doing your internal reporting. Because if you're constantly running cash statements or accrual statements, nothing's ever really going to line up. So as a small business, decide what you are going to present on, and then you have to stick with it to make sure that your reporting is comparable. So the fundamental accounting equation is assets equal liabilities plus stockholders equity. And this is what we see in the balance sheet, and this is why it needs to be balanced. Assets, so the left side shows that the assets are the economic resources of a company. The right side of the accounting equation indicates who has a claim on those companies' assets, whether it be a creditor, but did you borrow money, or an owner's claims in stockholders equity. Did someone invest in you, and are they expecting a return? So those are really important things to understand as we carry through our balance sheet description. And when you're in QuickBooks online, it's a little different. The way that you enter things, QuickBooks sometimes handles that accounting equation in the background for you. So they allow you just to enter something as a cash transaction, and they'll make sure that it balances out in a journal entry of some sort. So even though that's not something that you're seeing on a daily basis when you're doing the work in those modules within QuickBooks, it's important to understand that it is happening in the basis of the general ledger. And if you just look at your cash detail, you have all these cash transactions, but if you double click the transaction, you'll notice that it has cash on one side and a liability, a stockholder's equity, or a P&L offset for it. So just something to keep in mind. So we'll start with the classified balance sheet. The purpose of the balance sheet is to report the financial position of a company. And sometimes the balance sheet is called the statement of financial position. That's assets and liabilities and stockholders' equity at a specific point in time. The balance sheet is organized or classified to help users identify the economic similarities and differences between various items within the balance sheet. So this is back to that timing graph. While financial statements can be prepared for any point or period, most companies prepare them at the end of each month. So you can see here, again, we have our balance sheet at the beginning of the period and then at the end of the period. So typically, we look at the balance sheets after we've closed out those months and at the end of each period. So for a classified balance sheet, what does the company have, right? Versus how did the company get it? So the company would have current assets, long-term investments, property, plant, and equipment, and some intangible assets, and we'll go over those. And then the liabilities would be current liabilities like your AP, your accrued salaries payable, or long-term liabilities, which are notes payables and bonds payable. The purpose of the balance sheet is to report the financial position of the company at a specific point in time. The relationship between the elements of the balance sheet is given by the fundamental accounting equation. The balance sheet is organized or classified to help users identify the fundamental economic similarities and differences between the various items within that balance sheet. And these classifications help users answer questions such as how a company obtained its resources and whether a company will be able to pay its obligations when they become due. While companies often use different classifications and different levels of detail on their balance sheets, some common classifications are shown in this current slide.
I think if I can cut in again,
Mm-hmm.
we'll discuss the actual usage and breakdown of the balance sheet in more detail during the class. But just wanted to mention, I think for those of you who might be trying to pick up the basics of accounting while you're trying to keep things organized in QBO, the balance sheet is very often overlooked by beginner users of its importance to the health and wellness of the company. I think for a lot of new business owners, the focus can a lot of times be on the P&L and are we profitable? Are we not profitable? And that tells me whether I am a successful business or not. As you dive into a little bit more of the intermediate and advanced levels of business ownership and evaluating the health and status of your company, you'll really get to know the importance of the balance sheet, especially if you're needing to go to banks for funding or providing your business owners with report outs for how you're perceiving how your company is doing. You'll get to know how important being able to read and interpret your balance sheet and thereby assessing the health or lack thereof of the current status of your company. And it can give you things to aim for future business purposes, for changing the trajectory and the shift of how healthy your company may or may not be currently.
That's so true. And if you guys remember the question from Tuesday about whether investors or VCs, what they look for and what kind of analysis they do on your financials, especially for startups, they dig very heavily into the balance sheet. And they analyze really every single line item. So it is important to get comfortable with what's happening on the balance sheet to reconcile all of those balances to make sure that they are up to date and accurate, which David went through in his class. Yeah, Josh is right. It is often overlooked in small businesses, but it shouldn't be. So assets are divided into current assets and non-current assets. In a typical company, it is reasonable to designate 1 year as the dividing line between current and non-current items. However, if the operating cycle of a company is longer than 1 year, it may be necessary to extend this dividing line beyond 1 year so it corresponds to the length of the operating cycle. The operating cycle of a company is the average time it takes the company to purchase goods, resell the goods, and collect the cash from customers. I would assume for the bulk of your companies, it would be a 12-month period, but on occasion, there's a 13-month period. You never really know. So just something to keep in mind. Current assets consist of cash and other assets that are reasonably expected to be converted into cash within 1 year or one operating cycle, whichever is longer. And that's why inventory hits current assets, because you can turn inventory around typically in a year. Really, you should be turning it around much more frequently. Current assets are listed on the balance sheet in order of liquidity or the nearness to cash. Some common types of current assets are cash, short-term investments or marketable securities, investments in the debt and stock of other companies, as well as government securities, accounts receivable, the right to collect an amount due from customers, inventories, which are goods or products held for resale to customers, and other current assets, which is really just a catch-all category that includes items such as prepaid expenses or supplies. Assets are not classified as current. Assets that are not classified as current are classified as long-term or non-current. These include long-term investments, property, plant, and equipment, and intangible assets. Long-term investments are similar to short-term investments except for the duration of the holding. They can include land or buildings not currently used in operations. And additional non-current assets are property, plant, and equipment includes tangible productive assets used in operations like land, buildings, equipment, and furniture. So this would include what David went over in his depreciation class. So the building, if you own the building that you're occupying for your business, that would be considered a fixed asset. And intangible assets, these lack physical substance, typically just on paper. But that's patents, trademarks, copyrights, and goodwill. And goodwill is something that you purchase when you purchase a company, and it's that inherent value of the company over their books, what their books represent. So when you record that transaction, you record a portion of it to goodwill. Other non-current assets is that catch-all category, and that's sometimes deferred charges or other long-term miscellaneous items. I would imagine that a lot of you don't have other non-current assets on your financials. So now we're done with assets, we're going to liabilities. Current liabilities consist of obligations that will be satisfied through the payment of cash or by providing goods or services within 1 year of the operating cycle, whichever is longer. They're typically listed in the order in which they will be paid. Common types are accounts payable, which is an obligation to repay a vendor or supplier for merchandise supplied to the company. So all those bills you get in, they go to accounts payable. Salaries payable is an obligation to pay an employee for services performed. So you would record salaries payable when you are running your books on an accrual basis and your employees have worked and submitted time cards for a period, but they haven't been paid yet. So typically it means they've like worked a week, but they're not going to get paid until the second week of the next month. So you would record an accrued salaries for that amount. Unearned revenue, this is deferred revenue, which is an obligation to deliver goods or perform a service for which a company has already paid. Hold on just a second. So when Josh was talking about contract revenue a couple weeks ago, he was mentioning an opportunity where you may have received a cash payment for something, but you haven't necessarily earned the revenue yet according to those contract terms. So in that sense, you would record deferred revenue, and you'd be able to recognize the revenue from the balance sheet into your profit and loss statement after you've actually earned it. Interest payable, when this is an obligation to pay interest on money that a company has borrowed. So sometimes when you take out a loan, but you're not supposed to make monthly payments, then you're going to be accruing the interest on a monthly basis. So you really understand what your true payoff of that loan value will be. and then you'll see the corresponding interest expense on your income statement. And then income taxes payable, which is an obligation to pay taxes. And we talked about that, I think, last week, about capturing your tax liability throughout the year. So you're making sure that you have the cash to cover it. And it's not a surprise. It's not as much of a surprise when it hits the next year. Long-term liabilities are obligations of a company that will require payment beyond 1 year. Common examples are notes payable, which is an obligation to repay cash borrowed at a future date, so that's a loan. A bond payable, not as common, but they still are out there. It's a form of interest-bearing note payable issued by corporations in an effort to attract a large amount of investors. Stockholders equity is the last major classification on a company's balance sheet, and it arises from two sources: contributed capital, which is the owner's contributions of cash and other assets to the company, which includes common stock. And this is probably what a lot of you have on your books, is money that you put into your company to get it rolling. And then retained earnings, which is that accumulation of net income of the company that has been distributed to owners in the form of, that has not been distributed to owners. So it's that net income from the prior year that you're retaining in your company to fund those future operations. So here's our fundamental accounting equation again, but we've just added a few extra layers. So we have our assets, which is current assets plus non-current assets. Our liabilities, which are the creditor claims. So we have our current liabilities and our non-current liabilities. And then we have our stockholders equity, which is our stockholders equity, which includes that net income that's been rolled from the income statement. The balance sheet conveys important information about the structure of our assets, liabilities, and equity, which is used to judge a company's health. For example, the relationship between current assets and current liabilities gives investors and creditors insight into a company's liquidity, the ability to pay those obligations as they become due. Two useful measures of liquidity are working capital and the current ratio, which we talked about last week, but we're going to kind of put it into practice this week, or on Tuesday. Working capital and current ratios for the company are helpful in comparing two or more companies in the same industry as well, especially if the numbers are all over the place, but at least you can get an idea of what the ratios are telling you. So this is a slide from Tuesday, but that working capital is the measure of liquidity computed as current assets minus current liabilities. And we want that to be positive, because that signals that a company has adequate funds with which to pay its current obligations and is expressed in dollar amounts. And the current ratio is an alternative measure of liquidity that allows comparisons to be made between different companies, which is current assets divided by current liabilities. There's also the debt to equity ratio, which is outstanding debt divided by the book value of shareholders' equity. And the quick ratio, which is assets minus inventory, which is not as liquid as your other current assets if you have it, and divide that by liabilities, which is also called the acid test. If we look at some of those assets, we can also analyze receivables. We talked about this on Tuesday as well. How efficiently is the company using the resources at its disposal? And one of the most widely used asset management ratios is that AR turnover. So we take our net sales and we divide by average net accounts receivable. And in the example we went over on Tuesday, I think you remember we had a really high net sales, like 500,000, and our AR average was around 5,000. So we had a really great turnover because we're keeping that AR balance nice and low, which means our customers are paying us quickly. So this ratio provides a measure of how many times the average trade receivables are collected during the period. Changes in this ratio over time are very important. A significant reduction of receivables turnover may indicate that the management is extending credit to customers who are not paying, which many companies are probably seeing in the year 2020. Go ahead.
Julian, if I can cut in. Yeah, so I think that is one of the, in this industry, it's a very, very important ratio to be monitoring. I've seen it a number of times where companies will unknowingly get into really bad cash position and kind of be coming to us and saying, what's happening? How do I fix this? Why do I keep running into cash shortfalls, and what can we do to correct it? And oftentimes one of the first places that we'll look is their AR balance and their AR aging, and the quickness and efficiency in which they're collecting from their clients, and making efforts to be monitoring that and be challenging whoever is in charge in your company of collections, whether it's yourself as the accountant or whether you have your salespeople or your project managers that are manning that, making those, increasing your awareness and making those people aware of the importance of communication to customers that, okay, we invoiced you, we need this payment, and being a little bit more rigid about your collectability and the importance of maintaining a healthy accounts receivable balance and speed, because it can really impact your cash flow, especially over the course of time and when you're managing a number of projects at the same time. You know, if you're managing 10 projects and 3 of them aren't paying on time, it can really have a trickle-down effect on your ability to be paying for services or inventories that you need for other projects if your other clients aren't paying on time. So it is really important to be monitoring that, and Juliana will be showing you where in QuickBooks you can take a look at that and how you can best monitor it. But just as a great business practice, you as the accountant can be kind of a hero in monitoring that and be overly communicating, hey, this is the importance, instead of just hounding, this collection is outstanding, you need to collect it, but giving whoever's in charge of collecting the reasoning and rationale behind why it's important, to not just, we need to get the money at some point, but the importance of the quickness and efficiency of it will and could affect the long-term ability of the company to stay in business. And when you go to that level of communication with the people that you're having those conversations with, it can increase the urgency from them to actually incite some change and make sure that that's something that they're taking care of and regularly monitoring as an important part of their job.
Awesome. So we're gonna calculate that AR turnover on an Excel financial statements. But right now, I just wanted to touch really quickly on where to pull these balance sheets in QuickBooks Online. And because the sample company doesn't have a year's worth of data in it, I pulled some different financial statements for us to use as our example in Excel, but we'll just run over here. So this is how you run the balance sheet. It's really easy. There's a balance sheet comparison and a detail. So the balance sheet detail ends up pulling it similar to a general ledger detail. So when you pull it, it actually asks for a beginning date and an ending date, because it's not going to give you just all history. So just something to keep in mind. And the balance sheet summary is going to summarize everything. So if we look at the balance sheet comparison, and it needs to know what we're comparing to. And this is asking us to prepare it. Looks like we're going to go with the previous. Let's go with the previous period. And it's probably not going to give us any prior information because there's nothing in there. But just so you understand that this is a function that you can run in QuickBooks Online, and that way you can see sort of what your comparability is from the prior period or the prior year, depending on what you choose. And then you can run this, and you can also add in, some percentage changes, and I did it manually on our balance sheet that I will show you really quick. So here is an example of a robust balance sheet. Oops, lost my mouse. There we go. And I'll show you sort of how to run some analysis and do those ratios on here after we're done looking at the income statement. But this is a really robust classified balance sheet. But what I did was I added in this column to pull a month month variance from the December balance to the November balance, so I can see what the change is in dollar amounts and then what the change is in percentage. And this is going to help me see the trends of my company. And it's important to look at it in detail by line item to see what's going on. Like why, you know, why did accrued bonus expense jump up by $30,000? And you should have an explanation for that and understand what's going on. And each of these balances all have a supporting schedule that describes exactly what's in them at this period in time. So it's also important to make sure you have a really robust support system for all of your balances, because the worst thing is presenting on the balance sheet and someone asking you, what's that $185,000? And your answer is, I don't know. I'm going to have to look into that. So it's just, that's why when David went over all the closing process, it's a really important step to understand everything that's in there. And then a lot of times you can find discrepancies by doing this trend analysis, by looking at period to period. And you're like, I wasn't expecting an increase of 30 grand. I need to look into that. So it's a really important step in your close process to perform this analysis early on, and then perform it again when you're done with everything wrapped up. And then you can just, add in your own comments. And yeah, and we'll go over that for the income statement as well.
Juliana, I'm sorry, I have a question.
Yeah.
So is this the balance sheet?
Mm-hmm.
And when you said something about a schedule of being able to look at that number and see what that is that separately built?
Yeah, so when David went over his closing process about the things that you need to do to support each of these balances. So if we scroll up, accounts receivables first. So for accounts receivable, in theory, you should be able to run an AR aging at this date and time, and it should tie to this number perfectly. Sometimes it doesn't. And then that means you need to do some research and figure out what's going on. And then these are all going to have bank reconciliations to tie to them. So those should be good. But they're all separate schedules.
To clarify, some of these separate schedules might be contained in QuickBooks, like a bank reconciliation. Some companies do that outside of QuickBooks to double check it, but QuickBooks does offer modules like the bank reconciliation inside of it to be maintaining some of those inside. But some of the, like a prepaid expense, they don't have a separate module for that. So if you're reconciling that, like David was demonstrating, oftentimes the best way to keep track of that on an ongoing basis is to have an outside schedule to monitor.
And for prepaid expenses, David had a schedule that had monthly balances. So he can use that one schedule, and you can see all the historical balances, the balance for December, the balance for November, and each of them would tie to these balances right here. And same with deferred commissions, there would be a schedule to support what that actually means, because in theory, you're booking journal entries to this every month. And this is a line item to match the commissions with the contracts that they're being earned on. So if the contract's over the course of the year, the thought is that the commission is going to be over the course of the year earned. So you kind of recognize it over the course of the year. So there needs to be like a support for that. So A, you know what entries to book every month. And then B, you know that this ending balance is accurate. And then this property and equipment, this is probably all going to be one big schedule. You have one large fixed asset schedule with the corresponding depreciation, which accumulates it, which gets you your accumulated depreciation number. And then for liabilities, accounts payable is typically just the AP aging. Credit cards payable is, it's wonderful that QuickBooks lets you run your credit card similar to a bank statement. So use that credit card module within QuickBooks and reconcile it on a monthly basis so you have something to support your credit card payable balance. And then in this particular balance sheet, they reclassified the yearly amount due for loans payable. So that's why there's a current portion of loans payable. Accrued commissions payable and accrued bonus expense. That is, we're going to pay a bonus out in 4 months, but you earn it over the course of these 4 months. So you book a little bit of it every month to capture that expense in the current month. So that's that whole accrual basis of accounting, et cetera. So those are just examples. Sometimes you can have one schedule for like a section, but just as long as you're able to identify what's in each of those balances. And right now you might have a really simple balance sheet, but as you grow and your accounting gets more complicated and you get investors and you buy more equipment, things are going to get more complicated, and you're going to want to make sure that you have really clean support records for everything that's in there.
Okay, thank you.
Yeah, you're welcome. And for this particular company, I was hired to get them ready to be sold. And it took like 4 or 5 months of really extreme cleanup of their books because they didn't have accurate records to support all of these balances. So they ended up having to pay me a lot of money to do it. And it was really disappointing that they had thought that their current staff had been able to do that. So the earliest you can start doing it, I know it's so hard because you're so busy doing the day-to-day accounting, but that's why it's really important to set aside a week for that month-end close process so you can create these schedules. Okay, awesome. I'm going to go back to the PowerPoint.
And oftentimes the best place to start is just one by one. So choose 1 month to tackle prepaid. This month I'm going to build a prepaid schedule. So you're not taking on the entire load of, oh my gosh, I have to reconcile a balance sheet now, and okay, I have to create schedules for all of these different things. We definitely encourage a lot of our clients to take it in stride when they're not having to create financial statements quickly to clean up in order to get bank financing or to sell. If this is just a process of improvement task that you're trying to undertake to clean things up, definitely take a deep breath and choose 1 or 2 each month to say, okay, this month I'm going to detail out everything that's going into my property, plant, and equipment, and I'm going to create a depreciation schedule. And that's going to be my goal for this month to tackle, because we well know the rigors of maintaining the day-to-day accounting, and to add 20 tasks to that list is completely unreasonable. So adding 1 or 2 each month to be building your confidence, getting yourself there, so that a year from now you can be on that last set of smaller number balance sheet accounts, to be finally getting there and having your detailed support for each one that's built out and able to be maintained on a more easy and frequent basis.
Okay, on to the income statement. So the income statement reports the results of a company's operations, the sale of goods and services, and the associated costs of operating the company for a given period. The long-term survival of a company depends on its ability to produce net income by earning revenues in excess of expenses. The past income reported on a company's income statement provides investors with information about a company's ability to earn future income. The income statement consists of 2 major elements, revenue and expenses. Revenues are the increase in assets that result from the sale of a product or services, and they include sales revenue from products or services and interest revenue from investments. Expenses are the costs of resources used to earn revenues during a period, and they include cost of goods sold or cost of sales, selling, general and administrative expenses, research and development expense, and other expense. Selling and general and administrative expenses are the expenses to manage the company that are not direct product or service costs. So that's going to be rent on your building if you don't own it, or the utilities for keeping the lights on and getting internet in there. Research and development expense is the cost of developing those new products. Income tax expense is pretty self-explanatory. Companies prepare their income statements in one of two different formats, a single-step income statement or multi-step income statements. QuickBooks runs their income statements as multiple-step income statements. In a single-step income statement, there's only two categories, revenue and total expenses. The multiple-step income statement provides classifications of revenue and expenses that financial statement users find useful, with three important subtotals. Gross margin, which is net sales minus cost of goods sold. Income from operations, which is the gross margin less all those operating costs to keep your doors open. And net income, which is your income from operations minus all the expenses. This slide presents some common non-operating items that are important in computing net income. So these non-operating items are not going to be related to the ongoing business. They're going to be related to, oh, we sold this equipment, so we have to record that transaction, but it's really not related to our business activities. So some important ones are interest income on investments. So if you hold investments and you're getting interest, you have to record that on your income statement, but they would be below your operating expenses. Dividend income from investments in stock of other companies. Rent revenue, if you own the building that you're in and you rent a few of the spaces out to other people and you get rent revenue from it. You're not a real estate company, so that's not your main source of income, but you do need to record it. And gains on disposal of property, plant, and equipment. So that's if you're selling buildings or old equipment and you get a gain because you sold it for more than you had it as your book value, which is what David talked about a couple weeks ago, then you need to record that gain. Other expenses and losses are interest expense from loans. So if you have a bunch of loans on your balance sheet and you're paying interest on them, that's going to end up below operations. Losses from disposal of property, plant, and equipment. Losses from accidents or vandalism, which unfortunately, I think a lot of businesses in some big cities are recognizing right now because of some, riots and other damage to companies, to actual buildings, and losses from employee strikes and income tax expense. A company's ability to generate current income is useful in predicting its ability to generate future income. When investors believe that future income will improve, they will buy stock in that company. Investors and creditors' estimates of the future profitability and growth of a company are aided by a careful examination of how a company has earned its revenue and managed its expenses. A useful measure of a company's ability to generate profit is that net profit margin, which is sometimes called return on sales. It shows the percentage of profit in each dollar of sales, which is computed as net income divided by the sales revenue. So that's comparing your base net income at the very bottom of your income statement, which has all the operating expenses, all of the non-operating expenses taken from it compared to your actual company's revenue. And in the example that we did on Tuesday, we saw that the company had a really tiny net income, but a really robust sales revenue. And so it clearly looked like they were managing their expenses effectively. So there are other, and so that one rolls into the three common profitability ratios: the gross profit margin, which we just, gross profit margin, which is gross profit divided by net sales; the operating margin, which is operating income divided by net sales; and then the net profit margin, which we just talked about, which is net income divided by net sales. The analysts also like to look at operating margin and net profit margin percentages to see how much is left from a sales dollar after paying for the product and all of its operations. Trend analysis provides a means to analyze company data over a period of time by focusing on the change in specific line items within the income statement and balance sheet. Changes are typically measured in dollars and percentages. So we're going to go ahead and grab a polling question from you really quick. So the second polling question: do you currently perform trend analysis on your income statement and balance sheet? I'm seeing some yeses come through. That's great. And if you don't, then I hope that I can give you some tools in the next exercise that will help you perform some trend analysis on a monthly basis. Okay, awesome. Thank you.
To give you a sneak peek into the back end of Juliana and my jobs, trend analysis is often the first place that either of us will start an engagement with a new client. The first thing we'll do is have a new client send us their trended balance sheet and income statement, and we will take a look to see what we can find. That's one of the first places that we look, and one of the best ways for you to be actively maintaining and analyzing your own work, to be able to be catching things that happen in the normal course of business, mistakes that happen, misclassification of expenses, what have you. It's a great way to be self-checking your work if you're a department of one, which I would assume a lot of you are. That can make it very difficult to be actively catching any mistakes that exist until it's too late. But this is a great way to be checking your work and to be looking at things from a different angle than just being in the detail constantly.
And it really is the ideal way to check your work. It's a self-check, really. Like, did I miss something? Was I supposed to record something here and I didn't? Or, you know, why do I have expenses in every month but the current month? Are we missing an invoice and I need to accrue for that? All of those questions can be answered with a really quick and easy analysis. So, excuse me. So I took this sample profit and loss statement and I calculated the variance from month to month for for a dollar amount and also for the percentage amount. So a lot of times people create a threshold for themselves, like look for something that's over $5,000 and also a 10% deviation, and perform an analysis and comment on it. So we would go through and look for some things that meet the threshold that we set as appropriate and actually write down commentary on it. So when you give the package to the owner of the company, or when you're looking at historical packages and you're the owner of the company, you're able to see like, what was happening that month? Why did we do so well? And you're like, oh, there's a comment right there that explains it. So it's a really great way to summarize your financial information, and it's a good tool and one I would recommend always be done. So as you can see in this particular example, the total revenues are pretty consistent from the previous month, as is the gross profit. It's only a 2% variation. And as we go down, even a lot of our expenses are fairly consistent. I know, for example, some people quit. And so that's why the payroll expenses were actually less than the previous month. And I would capture that with a comment like 2 positions are currently open, and that's why these expenses are less. And I remember when we closed out this particular month for this particular sample client, we identified a lot of missing information by doing this flex analysis is what we call this. Especially, and we also found out that a bunch of credit card transactions had been booked to miscellaneous expense and hadn't been allocated. And we were able to identify that because we saw miscellaneous expense was crazy high, and then a lot of our reoccurring subscriptions hadn't been booked yet. So it's a really helpful tool. But what we're going to do right now is we're actually going to do some ratios, and kind of, I talked about this last week a little bit, on Tuesday, calculating the ratios and then spreading them out so you can kind of see a trend. So if we take our gross profit margin, which is our gross profit divided by net sales. So let's look for our gross profit, which is this line right here, divided by our net sales. So I'm just going to put that up here in the equation. And that's going to give us our gross profit margin. And then what I'm going to do is I'm going to drag that across for every month. which gives us our gross profit margin for every month. So right there, we've just plotted a bunch of ratios. Now we can see some trends. We can kind of create an expectation from this, and it should be around 88-ish%. Like, why is this at 85? You know, that would be a question worth asking. So let's look at the operating margin, which is operating income divided by net sales.
Juliana, while you're doing that, I'll speak to a little bit to gross profit margin and the importance of gross margin in the construction and construction adjacent industry in general. Like I talked about in our WIP accounting course, the purpose of doing that WIP analysis is to have and maintain a consistent profit margin, to actually be able to demonstrate on a monthly basis or on a periodic basis. Here we're looking at it monthly. Are our revenues matching our expenses for that period? And that's where you're able to have a consistent profit margin. Whereas if you're operating on the cash basis and your revenues are only hitting when you're sending out an invoice and your expenses are only happening when you're actually making a purchase, that's where that gross profit margin can fluctuate wildly and make that the information that's able to be gleaned from this type of an analysis really unreliable and unhelpful, because in 1 month you might have 3 sales of a job and be able to be putting out a few invoices for deposits from clients, so your cash looks really good, but you have no expenses, so your gross profit margin might be close to 100%. You might look really good because you had no costs, but you had all the revenue. But then the next month you didn't have any revenue and you had all costs. So your gross profit margin for the next month might be negative 50%. And that makes it really difficult to really understand how your company is doing consistently. So maintaining this shows the importance of maintaining accrual accounting to be able to more effectively analyze the performance of your company over a period of time.
Awesome. And this is a very accrual basis financial statement. So that's something to keep in mind, which is why we're able to show these. I mean, this is fairly consistent, right? And these big dips are related to some closing costs and some adjustments made because the company sold. So I can tell you that just from this, but generally speaking, their net profit margin is very low and negative in some months, as well as their operating margin. So that's definitely something that this company needs to focus on, is managing those expenses while still maintaining their level of revenue. So let's look at the balance sheet. I've also highlighted a few important lines here: total liabilities, total short-term or current liabilities, current assets. And let's create some more trend analysis down here. So we have our working capital, which is our current assets minus our current liabilities. So here's our current assets minus that. Doesn't look like all of the liabilities. So I'm going to have to make this, and this, and this. Okay. Yikes. That's not good. This would have been a scary month then. And as you can see, they had a big cash inflow in November related to that sale. But things were really tight beforehand. And generally speaking, these are fairly low numbers considering the level of operating expenses that this company has. So this would be worrisome. And it would indicate to me that they need to get some more cash. Okay, so current ratio equals the current assets, again, divided by, and I'm going to have to parenthesize this because I'm adding multiple, this plus this plus this to get us our total current liabilities. There we go. So this is a good month. We have double the amount of assets to cover our liabilities. So that's a hopeful thing for sure. Let's look at our debt to equity ratio, which is total debt divided by shareholders equity. So that's going to be all of these notes payable. So that gives us our debt to equity ratio. And then we have our AR turnover. So this was going to be a little bit difficult to pull, but I actually pulled in the net sales here, so we wouldn't have to go tab to tab. So what we'll do is this equals our net sales divided by our average AR. So we're going to say divided by the average of accounts receivable in the previous month, which we don't have. So we don't have it for that month, but that's okay because we have it for these months. Delete that. Okay, so there is our AR turnover. So after we have all of these ratios, and if you have a consistent template for your financials every month, then you can just copy these ratios over and just continue spitting them out every month. It'll be really easy. But if we want to get like a plot what our current ratio is, I'm just going to do a really easy version. I'm going to do a quick analysis. Okay, and let's look at charts and let's plot our line. And this is our current ratio. So there we are. We're creating kind of our own dashboard, if you will. And we can do that for all of these. So we can take our AR turnover and we can insert a quick analysis. Oops. Do charts. And there we get our AR turnover chart, and as you know, Excel has a lot of different ways to plot these out. You can, do the bars, you can do the plot points, you can do multiple in one chart so you can track how that's looking. So that's just a quick example. And if we go to our profit and loss, so look at that. Look, it adds a lot when you can visibly see and quickly see what your chart is looking like. And this is why in those dashboards, it provides that summary right there in front of you. So you can see like, bam, this is how we've been doing the last year. And this is what our gross profit margin has looked like. And so this is why it's important to create some sort of visual for you on a monthly basis. So it throws all of that accounting information in front of your face. So it's there and you're able to digest it and keep that in your mind as you're making decisions. I think a lot of us are visual, although not everybody is. I think you'll find most people that don't have a ton of time are extremely visual. So anything you could do to create this type of analysis and put it in front of the owners or the executive's face is going to help in the long run. And it also creates a really beautiful package. And those dashboards that Josh is going to go over in a little bit pulls all of this in automatically. So I just taught you how to very quickly manually prepare this if you need to. So that is an option out there, but there are easier options for a pretty low monthly fee. So that's something to think about. And I was wondering if we could do a quick break.
Yeah, I definitely think that this could be a good time. So if everyone wants to go ahead, we'll take a 10-minute break. I guess before we do break off, if Juliana doesn't mind for just a minute, does anyone have any questions about this first half of the presentation? I didn't see anything come through in the chat. Did anyone want to ask anything live? Either Josh or Juliana?
I just think that, this is really good, but you have to take the time to, practice, for it to really make a lot of sense. So,
Yeah, I think something that's really important when implementing these, because it can be a little bit of an information overload, and something that we practice when we're building dashboards for new clients, is really taking a look at the business and the business issues that you're facing, and keying in on the few metrics that make the most sense to be focusing on, to be implementing and making the changes that you're after. So if your company is experiencing cash flow issues, I would be focusing on some of those quick current ratios on the balance sheet as, okay, this is what I'm going to focus on first. This is what I'm going to wrap my head around. What's our trend for the company? We'll talk later about industry metrics that you can look at, and maybe emphasizing a little bit less your net profit margin. But if you're finding that, okay, cash isn't an issue, but man, it just doesn't seem like our net profit is reflecting how busy we are. We have all these new projects, but I'm not showing, it doesn't feel like I'm getting enough money out of this. So I would focus on your gross profit margin and your net profit margin, focus on those two, and really understanding, okay, here's what it is over the course of time. And then once you have that information, that can then inform you where you take, okay, what's going into that number? Okay, our revenue and our cost of sales are going into that number. Revenue is high, I know that, because we have all these projects. Cost of sales is also high. What's in that? Okay, I'm going to dive into that. Why is the amount that we spent on equipment rentals so high this month? Okay, let's dive into that. Oh, well, we spent $100,000 for a forklift that we never ended up using. Okay, now that informs me of why that's so out of whack, and maybe can inform your projects either that are ongoing or your next projects. Here's where we're wasting money, and here's where we need to be paying attention to be making our projects as profitable as possible. So it's kind of try not to, we present all these to give you a snapshot of here's all the ways you could look at all this information, but it can be really unhelpful to just go in and make a dashboard of all of these, because then most likely you're not going to look at any of them, at least from an informed standpoint. So try and key in on what are our issues that we're trying to work on right now. Maybe chart all of these out, but choose a few to really focus on that you can then use to make some more informed decisions, rather than just having numbers at your disposal or charts that tell you, okay, if the chart's going like this, we're doing good. If the chart's going like this, we're doing bad. Does that make sense?
yes.
Great. Any other questions before we move to a break? Happy to answer these questions. This is really helpful.
I'm not seeing anything come through the chat. So if we want to go ahead and just take a quick 10-minute break, I'm going to go ahead and put that clock on the screen for everybody. We'll meet back here. Let's see, what is it right now? We'll meet at 16 after the top of the hour. So I'm going to go ahead and put that in the chat, and then I'll also put that clock up for everyone. If you do have questions in the meantime, you can put those in the chat and we can address those when we come back from break.
Sounds great. Thanks, everyone.
All right, welcome back from break, everybody. If you could go ahead and click on that participants button at the bottom of your screen, and then click on that green check mark for me when you are back. We can go ahead and get started once we see that everyone's kind of filtering back in. Again, you can find that green check mark underneath the participants button at the bottom of your screen. All right, I do see most people are back, so I would say, Juliana, whenever you're ready, you can go ahead and get started.
Thank you. Sorry, I just had to turn a few things on. Okay, so to continue our discussion on financial statements, we're going to do a brief overview of the remaining two financial statements that aren't as frequently used but are important when you're trying to understand what's happening throughout the year. The retained earnings statement. So the owners of a company contribute capital in two ways: directly through the purchases of common stock from the company, or indirectly by the company retaining some or all of the net income each year that they've earned rather than paying it out in dividends. The income earned by the company but not paid out in the form of dividends is called the retained earnings statement. The retained earnings statement summarizes and explains the changes in retained earnings during the accounting period. So really you just start with your beginning retained earnings, you reduce the amount by any dividends that you paid out to owners, you add in the current period's net income, and then you get your ending retained earnings. It's really easy. It's a quick little roll forward, but it is important when you're trying to understand what's really happening in that account. Statement of cash flows. So performing a cash flow or a pro forma cash flow is a little bit different than the official statement of cash flows. The statement of cash flows is a financial statement that actually has a layout where you pull out your sources and uses of cash and break it out into three different categories. It describes the company's cash receipts, cash inflows, and cash payments, cash outflows for a period of time. Cash flows are classified into one of three categories. The cash flows from operating activities is any cash flow directly related to earning income. This category includes cash sales, collections of accounts receivable, as well as cash payments for goods, services, salaries, and interest. Cash flow from investing activities is any cash flow related to the acquisition or sale of investments, long-term assets, just as property, plant, and equipment. So if you are buying some new machinery or investing in something so you can earn some cash, then that's going to be represented in the investing activities. And the cash flow from financing activities, this is any cash flow related to obtaining capital of the company. It includes the issuance and repayment of debt, common stock transactions, and the payment of dividends. Because cash is the lifeblood of any company and is critical to success, the statement of cash flows can be an important source of information as users attempt to answer how a company generated and used cash during a period. Such information is helpful as users assess the company's ability to generate cash in the future. Creditors can use the statement of cash flow to assess the creditworthiness of a company. And a company with healthy cash flow, particularly if it comes from operating activities, is in a good position to repay debts as they come due and is usually a low-risk borrower. Stockholders are also interested in the adequacy of cash flows as an indicator of the company's ability to pay dividends and to expand its business. So the next slide is just a short video with a breakdown of the relationship that causes changes in cash flow, and I just thought it was a really great video. It's about three minutes or so. It's not. Hold on. There we go.
In the last video, using the accrual same month we saw.
Sorry about that. We're going to start over.
In the last video, using the accrual basis for accounting, we had $200 of income in month 2, but over that same month, we saw that we went from having $100 in cash to having negative $100 in cash. So we actually lost $200 in cash. So how can we reconcile the fact that it looks like we made $200 in income, but we lost $200 in cash? And that reconciliation is going to be done with the cash flow statement. So most cash flow statements, they'll start, so I'm going to do a cash flow statement right over here. So they'll start with your net income, or actually they'll start with the cash that you started out with. So they take you from this cash balance to that cash balance. So they'll say something like starting cash we know is $100. And then they'll say, well, in the most naive interpretation of things, your net income in theory should be cash you're getting, or at least it's some type of profit. You're getting some assets in the door, or at least you're counting as if you're getting some assets in the door. So then you have your net income during the period. And here we'll literally just take whatever is reported from the income statement. So over there we get 200 net income. And now we have to do the reconciliation part, because if this was all cash that you were getting, then you should have $300 in cash at the end of the period, which we clearly don't have. So we have to reconcile by looking at the changes in different things on the balance sheet. So over here we have a net change in accounts receivable. So we have an increase in accounts receivable. So I'll call it AR increase. AR short for accounts receivable, just to save some space. So let's just think about it. When you have an increase in accounts receivable, you're kind of letting people owe you money. You're letting people owe you $400. If you didn't let them owe you, that would have been cash. So you're kind of pushing back the time that you're getting cash. This is $400 that you didn't get, that maybe you could have gotten if you didn't allow, I guess, this person to delay when they paid you. So an increase in accounts receivables is actually less cash than you would have otherwise gotten. So this is negative 400 for your cash flow. And we had no other changes. I don't even address accounts payable here. That's essentially pushing back owing people, paying other people, paying your vendors money, but I don't even address that in the previous example. No other changes in our liabilities. So this is the only adjustment we make. And so if we do this, and sometimes this will be called a use of cash or subtraction from, or there's different ways that it can be phrased in different contexts. But over here you'll have your net cash from operations. Cash from operations, I'll just say ops. And over here you can see when you add it all, just the cash from operations, 200 minus 400, so I'm just adding this part right over here, you have negative 200. And so your starting cash is 100. You have negative 200 cash from operations. And this is what you would have also gotten if you had done cash accounting. You would have had negative 200 cash from operations. And then if you start with 100, you use $200 in cash, your ending cash will be negative 100. So this little thing that I just created here, this little reconciliation between the positive 200 in income and the negative 200 of cash, and showing how we got from this starting point in cash to this ending point, this is a cash flow statement. So you now know the 3 major financial statements.
So time for a polling question. Do you currently perform a statement of cash flow to reconcile your income statement to the cash account?
All right, I'll give everyone a few more seconds to answer. Looks like we have a few people who haven't answered yet. Looks like it's a even split.
Yeah, that's awesome. I'm glad to see that people are utilizing it. And if they aren't, hopefully that video gave a really brief overview of what is involved in the statement of cash flow so you understand how all of that relates to each other. So we talked about dashboards and ratios and KPIs quite a bit on Tuesday. I'm going to hand it over to Josh, who's going to walk us through a few sample dashboards that are available on the market so you guys can determine whether or not you think they will be beneficial to you. So I will stop sharing my screen.
All right. Thanks, Juliana. Yeah, so this is one of the things that I do most often with my clients is I implement dashboarding and reporting options. So I want to take you guys through some of what's out there, both internally in QuickBooks and what's out there externally that we at Clark Nuber use to create a little bit more detailed options for our clients. So let me start first by hopping into QuickBooks. So this is a little bit different than our sample copy that we've used. This is a sample that we have internally that I pulled up. So something I wanted to share, let me move my screen around a little bit so I can see everything a little clearer. So for those of you who often run into cash flow problems, something that you can implement right now if you wanted to monitor your cash flow directly within QuickBooks Online. QuickBooks Online is actually making a big push into the cash management inclusiveness and comprehensiveness of in its product. So not only are they adding features for you to be able to see and monitor your cash flows, as of last month, QuickBooks is now offering a QuickBooks bank account and QuickBooks debit cards to make it even more comprehensive for its users. It's not mandatory, but it's just another offering to show how much they're investing into QuickBooks Online and small businesses to make it a more united journey should people want to have everything solely integrated and quickly integrated rather than having to balance how does Bank of America integrate with here, or I work with a credit union and they don't allow me to import my transactions directly. QuickBooks is trying to make that even easier for its small business clients and adding things like a no-fee bank account and debit card option. So just so you know, those are out there. We can provide more information to you should you need, or the information is out there with a quick Google search. Like I said, that's really recently launched. So I don't know what the reviews are for it, how it's going, but it is something that's out there. And I know QuickBooks is putting a lot of energy and money into making that the desired setup for its organizations. So like I was saying earlier, something that you can implement right now for monitoring your cash flows is if you go up to your settings and you look into something called QuickBooks Labs. So this is where QuickBooks will often demo some things they're trying to be rolling out. And if you are interested in other things they're rolling out, there's just a few different options in here. And it's something that you can be checking in on for what they're releasing coming up. But right now they have something in their QuickBooks Labs that you can access. If you scroll down, you can turn on something called their cash flow dashboard widget. There's no cost to it. It comes with it. So all you need to do is flick it on, and I think there's a problem because I already had integrated it and then I turned it back off. So it actually is showing up in my QuickBooks. So this is what it looks like. And right now this version of QuickBooks doesn't have a bank account linked to it. So that's why it's giving me a notice to say, link your bank account and we can show you the information. But this is an example of what it would look like should you have your bank account linked, which I'm sure most of you do with your QuickBooks account. So it's going to give you both your historical money in, money out for each month, which will then show you, okay, how did we do that month? And you can look at that trended over the course of those months. But what they're actually trying to be building out as well is taking your historical information and trying to project out your future cash flows as well. I don't know all of the algorithms they're using to be able to make those adjustments. I believe there's reading you can do about what they're trying to do in terms of reading your historical data to project your future cash flows. But if you look here, these little grayed out areas or hashed out areas, and these for the future months are them saying, here's what we predict for your future cash flows. So this can be an easy tool to implement to both see on an easy integrated chart, so you're not having to create this in Excel like Julianne was showing for some of the other KPIs you can be measuring. But this has it built in, and they're trying to also be tooling with integrated cash flow projections as well.
Josh, is that in the on the desktop under reports?
Is this in the desktop version?
Uh-huh.
Not that I'm aware of. I believe that this is only for QuickBooks Online users. I don't know offhand if I don't think QuickBooks Desktop quite has the same level of integrated widgets as QuickBooks Online, especially since QuickBooks Online is into its new desired product for people to be buying. They're not doing as much integration like this with QuickBooks Desktop. You'd be able to pull the information out of QuickBooks Desktop to create this yourself, but I don't think there's anything built into QBD right now to be creating this live like they're doing here.
I do see that there is a cash flow, let's see, what is it? Cash flow forecast? Is that the same thing?
It very well could be, yeah.
Oh, okay. Thank you.
You're welcome. Any other questions off of that before I move on? So that's a fun new tool that they just started rolling out, I believe a couple months ago. On top of that, if you are a QuickBooks Online Advanced user, something that they have integrated directly now is something called Business Performance, and they have this separate tab for it. So it's in the reports area under Performance Center, or I can just click this button to go there. Again, this is for QuickBooks Online Advanced users only. Oh, sorry about that. But this is going to let you not only have some built-in KPIs and dashboarding tools, but it's actually going to have some industry comparison data as well. So let's say I want to say I'm in construction. They're going to have multiple different types of construction, so you can choose what you're in. So let's say we do commercial and institutional. I don't know why this is being a bother. Let's try it again. There we go. So I can set that, and they're going to take information based off of other people in similar industries and industry data, and we're going to be able to directly compare our monthly and annual results against industry records as well. So you can set your location as well so that it's specific to where you're doing it. So you're not just comparing against the nation, but construction in the greater Seattle area is probably going to be different than construction in Omaha, Nebraska. They might be similar, but more than likely they're going to be very different, and you're going to be wanting to set your metrics a little bit differently accordingly to kind of how the economy and this industry is doing in a certain time period. So this is going to allow you to both have access to the standard charts, so your AR analysis, your AP analysis, and give you some visuals to see the split for the aging of each, expenses over time, revenue over time, gross profit over time. So some of these that Juliana was showing you how to build in Excel will come fit right here at your fingertips. Net profit, current ratio, quick ratio, and here's where it'll show your industry benchmarks. That's what it looks like to show you if your trend is up here, here's the industry down here, you can show, great, we're doing a lot better than the industry. So it gives you some other factors to be comparing against rather than just saying, okay, our net profit margin is 6%. What does that mean? Is that good? Is that bad? Should we be reaching for better or worse? Okay, it's consistent over time, but is it consistently good or consistently bad? And this can kind of give you a little bit of information on that as well. Other resources for benchmarks, if you don't have access to this functionality within QuickBooks Online, if you don't have the advanced version, I would encourage you to reach out to, if you're a part of any associations, construction associations, they might have benchmark analysis as well to provide you. A lot of those either regional or national associations will be doing frequent polls of companies that are involved in order to get some reliable information for you to be able to get access to see, okay, nationwide, the net profit margin for my type of industry is 5%. I'm at 2%. Okay, there should be room on an average basis. There should be room for us to do better. So there's our metric, and that's going to be our aim over time to improve our business to that number. So I would encourage you, if you are a member of any associations, to reach out to them, or if you have other contacts in the industry, we can also provide you with some of that information as well. But I would encourage you to do some of that searching around because that information definitely is out there. And I can actually pull some of that up right now. Do we have any questions while I'm pulling that up?
Does the QuickBooks Online export well into other types of programs?
Like what? What type of program?
Like the Bluebeam?
Like an Adobe, like a PDF program.
Oh, for that information?
Yeah, Bluebeam is a PDF program like Adobe.
I see. So that's actually one of the that's one of the biggest downfalls of what I just showed you, that Performance Center is, even though it's available for QuickBooks Online Advanced customers, it's only accessible for admin users. So it is a bit restrictive in how widely it can be used within a company. And they currently don't have any ways for you to easily share that information with other people. So if you wanted to create a report and send it out to the owners or to your PMs, you'd have to go in and manually create those things, or do something which I would consider risky and give them admin access to see it themselves. So that's kind of one of the only restrictive things about that information in that Performance Center. So it comes with pros and cons.
So are you saying that it has limited users online?
So just that one function, just that Performance Center function, Where it
Okay,
has access to all those metrics is limited to only be able to be accessed by users with admin access.
gotcha.
And you could take a screenshot with the
You
snipping
could,
tool
yeah,
and put it
yeah.
in a Word document and print that to PDF if you wanted to
Mhm.
include it in a package. So there are ways to include it in some sort of management package if that's what you're looking for,
Yeah.
but it doesn't allow you to export it from QBO, unfortunately.
Yeah.
And Josh, I sent you a question in Teams.
Oh, let me.
Sorry.
I can't open it.
Oh, well, I can read it. So,
Okay.
when I was talking about creating the dashboards and looking at the flux analysis and expenses and everything, you responded to a question that Sharon had right before the break. And they were wondering if you could demonstrate how you would troubleshoot on a financial statement, with several different scenarios, like one of them being your expenses are too high. How would you how would you use this information to troubleshoot an issue like that?
So the question is, in doing a flux analysis, how would you troubleshoot going from seeing that something is too high to actually fixing it?
I think so. Does that sound about right?
Yes.
Yeah. So in doing the flux analysis, the first thing I would do is look for those glaring variances, and then I would go into my QuickBooks Online and find whatever account is associated with that for the given month, and do a detailed P&L or detailed balance sheet, depending on which one you're looking at, and take a look at what transactions hit during that month, or if, for example, something appears to be too low, what transactions happened in the month prior that didn't happen in the month that you're looking at, or the most recent month, and kind of backing into what information might be miscategorized, therefore making the balance of the account too high and needs to be moved to a different account, or information that's missing. Okay, if you're doing that analysis and you notice, okay, our trend is rent every month is $7,000, and all of a sudden we have a month where rent is zero. Wait, did our rent not get paid? Okay, I'm going to drill down into our P&L, or maybe go look at our vendor for who we pay rent to and see, oh, did we miss paying rent this month? Okay, that's something that I can catch. So it's kind of going from high level and figuring out where you need to drill down into the detailed level. That's how I would troubleshoot that myself.
And in another scenario, if you're noticing that your cash is going down and your expenses are remaining consistent and your revenues consistent, then I would look at the variances that are located on the balance sheet, and I would check to see if your like your accounts receivable went significantly up, which would reduce the cash coming in. So that using that flux analysis to see, we've already done it on the income statement, nothing looks weird. So then start to dig into that balance sheet and see what's happening. Maybe you made a big fixed asset purchase and you just forgot. So you can look at fixed assets increasing over a month, and those typically don't increase frequently. So that would be something that would really spit out at you. And a lot of times those types of things can happen under the radar when you have people with credit cards and they're using a credit card system, and so they're entering everything themselves, or something just may have been miscoded, right? Like, we didn't purchase anything for fixed assets. How did this get in here? That was actually that should have been in cost of goods sold. So it's just really trying different scenarios to figure out what's causing that, and learning the places to check to identify what those issues are. And sometimes it might be an accounting error, and sometimes it might be that person shouldn't have bought that. So sometimes
Yeah.
it might be, you know, a management error. You're like, stop spending money. We don't have the cash for this. So, you know, a lot of things can be tweaked or changed based on the information that you find, but it's just getting yourself comfortable with that analysis and using it to your advantage.
Yeah, I think as most of us, if not all of us, know, the devil in accounting is in the details. The use of that trend analysis is to not have to be looking at every single detail every single month, and to take it from a high level to be able to say, okay, what is our normal, and what looks abnormal while I look through this, and then being able to take that and drill down and figure out, okay, what should our normal be and what's missing, either to make this too high or too low, or a business practice that shouldn't have been happening. Okay, expenses are way higher for supplies this month than last month. Let's dive into that. Okay, they all appear to be actual supply purchases. Who's in charge of ordering supplies? What are they ordering? Oh, wow. Who approved those? Were those supposed to be approved? Oh, those weren't approved. So we need to have some conversations with that employee about why they're purchasing those things. And that's a really good practice to be doing in general. But to be doing it, to be able to do it from that standpoint, to not have to be monitoring every single transaction on a transaction by transaction level, but being able to see that trend, to be able to see those things that may be extraneously happening that you should be monitoring.
And Josh, earlier you mentioned there's a couple, like a gross margin, gross profit margin, and things like that. Do you have any benchmark you could share with us, like within what percentage tile that we should be shooting at for construction firms?
That is a great segue. I really appreciate that. You have no idea. That's exactly what I was going to next. So I actually pulled these. So there's a lot of information out there, but I didn't want to overwhelm you. So just to show what's out there. So this I took from the National Association of Home Builders. So I don't know how many of you are in home building. So this is for that type of work itself. But like I said, if you're a part of an association or your particular business type has an association, either national or regional, a lot of them do have this type of information available. So you just kind of have to know that it's there and ask around, and somebody should be able to point you in that direction. So be that as it may, the National Association of Home Builders is giving this information for what's a typical balance sheet like for the average home builder in America. And again, this is in America and an average. So if you're higher or lower, it doesn't mean you're doing it wrong. It just means this is the typical picture that they're seeing for you to benchmark yourself against. So you can see, and it changes over time and with the economy. So that's why it's also important to be running yourself against what's going on, so you feel a little bit less crazy about, okay, things like we were on a really good clip there for a while and all of a sudden our profits are horrible. It might not just be you, and it might not be necessarily your poor business practices or accounting failures or anything that you're doing necessarily wrong. It could just be the impact on your industry economically, and it could be affecting everyone else. So this kind of can normalize how you look at those numbers beyond, do we have a consistent trend, and are we trying to aim for higher constantly, but to be able to weigh yourself against what's happening. So you can see over time, balance sheets have really dipped, and this was around 2010, so right after the 2009 financial crash, and then things have been rebounding ever since and kind of leveled out a little bit. And then your percent of assets of liabilities as opposed to equity. So you see, lending before the crash was really, really high, which might have been an indicator that there was a crash incoming because people were very highly debt leveraged. And that's really since normalized into, and I think that's a reflection of how much or how heavily banks have ratcheted back their lending. So this is about the average of what your liabilities, so your debt, both to your suppliers and to your banks, should be in proportion to your assets, and then therefore what flows out for what your total equity in comparison to that should be. Likewise, this is what gross profit margin and net profit margin have been over the course of time for home builders. So as you can see, before the crash, things were great. After the crash, things were really, really tight and really hard for both gross profit margin, and net profit margin was awful for a while. This was not the industry to be in 2008, but have since, again, rebounded. So when you're doing this, if you're a home builder, if you do your analysis for your net profit margin and you're consistently at 3%, that's going to tell you, hey, there's some room for us to grow. Maybe we're not pricing ourselves well enough. Maybe we're not picking the right jobs. Maybe we are spending too much and need to be doing some self-assessments. If you're at 8%, maybe you can pat yourself on the back and not have to be worrying so much about your net profit margin, and you can focus on other metrics that can be improving your performance over time. So like I said, these are really good resources to have access to, and there's a variety of ways to get that, but I would start with, because it's so industry dependent, start with any associations that you're either involved in or can get involved in, to see if they do that, because this information comes out of polling of other companies that exist like you. So the most likely culprit of somebody who would have access to all those companies that you're competitors with would be those associations that you all belong to. Any questions about that before I move on? No? Okay. I had to check up and make sure that I was even still connected, because that would be very embarrassing if I was giving all of this diatribe and I realized, oh, I'm not even connected to Zoom anymore.
What was that, Heather?
Oh, I was just saying I'm sorry, Josh. I saw you looked up and
no
then
problem.
I was on mute as well. So even some of us have our tech days, but no, there's nothing that's come through the chat box yet.
Okay, no problem. Let me roll through my notes real fast. The last thing I wanted to go over, so in terms of dashboarding, so Juliana shared a way that you can create it in Excel when you are exporting your financial data, creating it with basic charts and making that for yourself. There are ways, like I showed, to do it with internally in QuickBooks Online with that dashboard functionality that they have for advanced users. There are also a lot of other options out there for external sources that can be either very, very dynamic and a little bit overwhelming to some users, like Microsoft has as Power BI, which is their kind of dashboarding software. There's also Tableau, which is another really big, well-known company that does dashboarding offerings. Both of those most likely are a bit bigger and a little bit more difficult to pick up off the cuff for small businesses, but they are out there, just so you are aware that those tools do exist for you to be able to take your data and export it and be able to manipulate it and put in all these fancy charts to be able to start doing some of this more intricate analysis of your numbers. There's also the QuickBooks Marketplace. I would highly suggest roaming through, both for dashboarding, utilities, and a lot of other add-ons to QuickBooks Online. For those of you that are on QuickBooks Online, the Marketplace is a really good place to be searching out for what's out there for easily integrated add-ons, both for, I think I mentioned in my class, both for things like dashboarding, but for timekeeping as well. Things like project management. I would highly recommend diving into the QuickBooks Marketplace. There's a really great review system that will really quickly demonstrate what's popular, what's affordable, and what's easily integrated. Is that somebody with a question?
I think that might have been someone with a technical difficulty.
Okay, no problem. Outside of the marketplace, internally here at Clark Nuber, we have an offering for a tool that I actually head up the implementation of. So it's a reporting, dashboarding, and forecasting tool. So I'll show you guys the outputs that we will typically shell out to our clients who subscribe to our reporting or dashboarding. Oftentimes it's monthly, but some people have it on a quarterly basis.
What are we here for? Okay, let's go get
So this is an example dashboard that we might have for a client. All of this is customizable based on what we perceive via conversations, what your needs are and what you should be focusing on. Like I mentioned earlier, if you're looking at too many things, it can become ineffective to be looking at it all. But if you narrow it down to 3 to 5 key metrics that you're monitoring over time, this can be a really great tool to be pursuing the growth and change that your company needs or desires over time. So this is an example of something that I would call a balanced dashboard. So it looks at what your gross profit is over time and what your projection might be if you have a budget integrated with your QuickBooks or QuickBooks Online. Our tool integrates directly with what that budget is projecting you to. So it not only shows your historical performance, but if you were to stay true to what your budget says for the remaining months, here's what it would end up being over the course of time. Take a look at your operating profit, how that's fluctuating, what the projections are, and how it's all shaking out with a trend line over time. And then you can also build in your benchmarks as well. Things like your balance sheet split. Okay, how are you doing in terms of meeting some of those metrics on what's in the bank compared to what your liabilities are and your equities? Are you over leveraged? So if yellow is the primary color here, showing that our most of our balance sheet is debt, that's going to give you something to work on, that we are over leveraged and need to bring in more cash and receivables. Analysis of your top 10 operating expenditures. So you can see, okay, well, why is, we're a construction company, why is travel over half of our expense? That shouldn't be. Either things are misclassified or somebody's buying things they shouldn't be. So let's take a look at that and figure that out. Or you can take this over time and see, okay, we really want this to be only half of what we're spending our money on, whether it's personnel. It can give you a good gauge of what you're looking at. So there's a lot of different metrics. So like I said, this is what I would call a balanced one. So it looks at things like your gross profit, your operating trend. So it looks at your P&L and your balance sheet in a number of different ways to give you a broad sense of how you're doing. We also have them that are cash focused. So, okay, we're constantly having cash problems. So let's look at that balance. What's our change? How are we doing? What was our cash on hand historically? And are we trending in the right direction or the wrong direction? Revenue is one of the biggest factors in cash. So is our revenue up or down year over year, month over month? How is our liquidity? Is our cash on hand compared to our accounts payable? Are they close? Are they not? Do we have enough cash on hand to be paying our accounts payable? Or if people start knocking on our door asking for us to pay for that inventory that we bought last month and put on our credit card or on credit with them directly, are we going to be able to pay all of them in a timely manner? Or do we need to start having conversations to push some of that debt out so that we can re-leverage ourselves? These are all a bunch of different examples of the different outputs that we can have. We customize these for you directly. To me, these are a lot of fun to create because I don't just create them for nothing. I create them out of conversations. I create them based off of your needs and customize them to what you guys are looking for and interested in changing about your company. So these are just kind of broad examples of both the different ways that you can be organizing things yourself, or ways that if you were to want to engage with us, ways that we could be assisting you with this information analysis as well. Here's another type that we can churn out called a business performance report. So if you have things that you're trying to really achieve, so you have a revenue goal for the year and you're really trying to achieve it, and you want to report out to the business owner how you're doing year over year, or you're trying to achieve a goal for revenue for the entire year, how are you doing on that, so that you can both rejoice when that line is green and you're hitting your targets and you're over your expectations, or when it's red, okay, let's show this to everyone and gain some momentum around selling or being really diligent about ratcheting our purchases. And it can all come with narratives so that everyone involved can be aware not only of the numbers going on, but have the narrative involved with here's what happened and here's what we need to have changed going forward. I also build these comprehensive financial reporting packages that basically combine the visualization of dashboards with customizable balance sheets and income statements, so that you can be more effectively monitoring things, but not have to bear the burden of creating these yourself on a monthly basis. And they look really pretty too. We can come with highlights of how you did, both in narrative form. We can build in metrics for things you're trying to achieve, both on a financial standpoint and other things that you're trying to achieve, like we want to change, we want to implement Salesforce. Okay, how are we doing on that? Let's set what needs to happen in order for that project to be complete, and show progress so that everyone sees how we're doing and to be able to hold each other accountable there. So here's a very basic P&L, so that you're not constantly overflowed by, okay, we have a P&L that's 50 lines long, and I get to line 20 and I'm tapped out and I don't even know what I'm looking at anymore. This can kind of really pare it down, or we can customize it to be longer so that you can be doing a detailed analysis as well as a summarized analysis. But it also comes with the charts and visuals to be able to be understood by those that you might be presenting this to that don't have a financial acumen, but something makes sense when they see, okay, our revenue is trending this direction. Got it. That makes sense to me. And you can have the detail support to be explaining to them exactly, with the numbers included, why that is and what that exactly means. I'll scroll down. We can include non-financial metrics as well. This comes with a cash flow statement that's built. So if you find creating a a cash flow statement cumbersome, or if you've never done it and don't even want to think about it, our tool that we have integrates this directly. So there's no work involved, and it gives you the same information that you'd be creating from scratch anyways. And we also have this really cool visualization. This is probably one of my favorite portions of what we create. It's a different way, like Juliana was describing, and that Khan Academy video was describing, a fun and really effective way to visualize change in cash over time when you can't quite explain, all right, our cash was 7,000 this year, or this period, and we ended at 100,000, but we had 413,000 in revenue. How did we only end up with $100,000 in ending cash? It really shows you visually, okay, this amount was from revenue, then we spent it on COGS, then we spent it on overhead, then we gained some more in how quickly we were collecting our accounts receivable, then we lost it in how quickly we were repaying our accounts payable. this is a great visualization tool to both for yourself have a different look at where did our funds go, but then to be able to relay that information to people who might not have that financial acumen to fully understand why do we always have so much revenue but so little cash. Help walk me through. This is a great simple walkthrough of where that money went. Like I mentioned, we can implement non-financial data as well. So if you have hourly rates and they're going up or down, we can show that. We also can do Google Analytics. So I have one client where we're able to show their website traffic and be able to compare that against revenue to see if there's a trend with how often their website is being visited, and that can then gauge how much they're spending on Google ad buys to know if that's actually paying off for increased revenue, or if that's just generating more hits to our website, but it's actually not leading to more phone calls, leading to more business. So you can do some of that extraneous but really helpful non-financial but still data-driven analysis to be creating some different ways of affecting change in your company. Other things it does is you can take a look at social media. So if you have a presence on Twitter, Facebook, LinkedIn, you can, and you're trying to figure out, okay, which one of those or all of those do we focus on for buying advertising with, if any of them. You can see how those trends will affect your revenues or not, how many clicks you're getting off of those, how many website visits are being generated from those. It can be a really great tool to take a comprehensive look at all of the goings on of your company. I'll jump off my soapbox from there and open this up to any questions. Hopefully that was helpful for some of you to see the different resources that are out there for financial analysis. There's a lot of options out there, some easier to implement than others, some that we in the accounting industry really gravitate towards than others, because ultimately at the end of the day, the most useful tool is going to be one that you're going to be using and can understand. So that's what we strive to do when we engage with companies like yourselves who are coming to us with help us to understand our business better. We love asking questions and providing you with tools that are going to be helpful to exactly what you need, rather than just kind of giving you, here's 1,000 different metrics, you figure it out. We really like to cater to what your needs are in particular, based off of how your company is doing and what you're seeing from the ground level. So from there, that's all I have. I think that's all Juliana has. We're willing to stick around for questions. Thank you all for showing up today, and we really appreciate it.
And I added all of our contact information on this final slide for all of the presenters over the last few weeks. David and Shireen on there as well. So just reach out to us if you have questions or need help.
Yes, awesome. Thank you guys both for joining us. It's been a wonderful last couple of weeks with you guys, learning a lot about just different accounting things and some real great things that you guys should probably be looking at, especially when you're just starting out your new businesses. Get started on the right foot is the best way to do it, I think. Does anyone have any final questions for Josh or Juliana before we let them go? I didn't see anything that popped up in the chat. I think you guys just explained everything really well today. So I guess with that, if there aren't any more questions, if something does come up, feel free to email Jessica or Lily. They can get your info over to Juliana, Josh, or any of the Clark-Nuber presenters. So we want to thank Juliana and Josh again, and all of our Clark-Nubers for joining us. We hope you guys all have a great rest of your day. We'll see you again next week.
Thank you so much, Heather.
Thanks, everyone.
Jessica, if you want to come back on camera real quick, there's 2 SBTRCs. I think you and Lily are both still here. So I want to make sure to assign whoever wants to take over. Let me go ahead and make you the host. All right, there you are. I will talk with you guys soon. I hope you guys have a great next couple of sessions as well. Let me know if you need anything. I will still be accessible. I just won't be available for the actual.
No problem, Heather. Thank you very much, and have a great vacation and happy early birthday to you.
Oh, thank you so much. We'll see you guys soon. Have a good one. Bye.
Thank you.